Hey everyone, and welcome to The Explainer. Today, we are diving headfirst into a seriously fascinating case study in modern financial engineering. We're talking about something that completely turns traditional dividend investing on its head. We're going to examine Roundhill's AAPW WeeklyPay ETF. Now, this is an exchange-traded fund designed to do something that honestly sounds almost impossible at first glance. It aims to wring massive, weekly income out of a stock that is famously stingy with its dividends. So, how does it actually work? What are the hidden mechanics making this possible? Well, we are going to break down all of this complex derivative machinery step by step, so you can fully grasp exactly what's happening under the hood. Here is our roadmap for today. First, the weekly yield phenomenon. Second, inside the swap structure. Third, volatility, the income engine. Fourth, understanding return of capital. And finally, the risks of leverage. All right, section 1, the weekly yield phenomenon. Okay, let's just address the elephant in the room right off the bat, shall we? Apple as a company is highly regarded for its massive growth and total tech dominance, right? But it is absolutely notorious for having a tiny dividend yield. So seeing an Apple-focused ETF advertising a massive yield presents this huge paradox. You really have to ask yourself, how is this mathematically possible? Well, get this. As of July 17, 2026, the AAPW ETF boasts a massive 30.05% distribution rate. But if you look a little closer at the fund's 30-day SEC yield, which, remember, is the standardized yield reflecting the actual dividends and interest earned, it sits at just 1.58%. Wow, that massive gap between 1.58% and 30.05% tells us right away that this income is definitely not coming from Apple's corporate dividend payouts. So if you go out and buy Apple stock directly, that gives you a standard 1x return on the stock's performance, plus those relatively small quarterly dividends. AAW, on the other hand, is a totally different beast. It targets a 1.2x leveraged return on a weekly basis, effectively manufacturing a synthetic weekly income stream. To really understand how they build that synthetic income, we have to look closely at the fund's architecture. Which brings us to section 2, inside the swap structure. Let's play financial mechanic for a minute and literally pop the hood on this ETF to see the engine. Now, you might think an Apple ETF is just a giant bucket of Apple shares, right? Actually, no. In reality, only 11.93% of the fund is actual Apple stock. The vast majority of the fund is held in derivative contracts known as swaps. Specifically, we're talking about swaps with Goldman Sachs making up over 57% and Nomura making up almost 50%. And yes, I know the math exceeds 100%, but that's exactly the point. It represents the leveraged exposure of the fund. So what exactly is happening here? It's all about the total return swap. This swap structure is literally the underlying foundation behind these massive distributions. A total return swap is essentially a derivative agreement traded over the counter between two parties. The ETF pays a set fee to these major banks, like Goldman Sachs and Nomura. In exchange for that fee, the banks agree to pay the ETF the total return of a specific asset. In this case, that asset is 1.2x the return of Apple stock. This exact swap structure is the crucial mechanism that generates the leverage and allows the fund to amplify its returns without having to actually go out and buy 120% worth of physical Apple shares. But more importantly, using these swaps is highly capital efficient. It frees up cash that the fund then uses to power its synthetic income generation. But you should know there is a very strict timer on this mechanism. This leverage is specifically engineered for a calendar week. The fund's exposure resets every single Friday at the close of trading. This means the ETF aims to capture 120% of Apple's move from Friday close to the next Friday close. It is explicitly not designed for tracking daily returns, and this continuous weekly resetting of these swap agreements is exactly what dictates the entire rhythm of the fund. Section 3, volatility, the income engine. If we take a look at recent distributions from June and July 2026, notice how wildly the payouts fluctuate from week to week. 1 week investors got 27 cents per share. The very next week, it dropped all the way down to roughly 10 cents. Then it bounced back up to 23 cents, then down to 9 cents. This is absolutely not a fixed, predictable paycheck. The distribution is calculated weekly based on a proprietary formula that relies heavily on Apple's recent performance and its implied volatility. To really wrap our heads around this, let's turn to some research from Tidal Financial Group. They define implied volatility, or IV, as the market's forward-looking forecast of how much a stock's price might swing in the future. IV is the secret ingredient here, guys. It dictates how much option buyers are actually willing to pay. Because the fund uses those swap structures we just talked about to gain its leveraged exposure, it has the capital flexibility to harvest these highly inflated options premiums when volatility spikes. The swaps give them the Apple exposure, but the volatility, that's what gives them the cash. Basically, during periods of high volatility and uncertainty, like, say, right before a major Apple earnings report, premiums surge. The fund captures this, and that leads directly to those larger 27-cent payouts. Conversely, during low volatility, when the markets are calm and complacent, those premiums shrink, leading to the much smaller 9-cent distributions. The income stream naturally expands and compresses based entirely on whatever the market conditions happen to be that week. Section 4. Understanding return of capital. Now, according to the fund's recent 19A1 notice, which is the document that alerts shareholders to the actual source of their distributions, a staggering 100% of the distribution composition is estimated to be return of capital, or ROC. Simply put, from a tax perspective, these aren't your traditional corporate dividends at all. The mechanics of return of capital are kind of unique. ROC is essentially just a portion of your own invested capital being handed back to you. Because it's your own money, it is not immediately taxable in the year you receive it, which sounds great. However, it reduces your cost basis in the fund. Let's say you bought shares at $40 and you receive $1 in ROC. Your new basis for tax purposes is now $39. Once your basis hits zero, any further distributions become taxable as capital gains. So it definitely offers current tax advantages, but it's absolutely vital to understand you are literally receiving your own principal back. Section 5. The risks of leverage. Okay, let's talk about the catch, because the fund's prospectus is very clear about the core structural risks involved here. First up, leverage risk. Amplifying gains is awesome, but it also means magnifying losses. Next is counterparty and swap risk. Remember those massive Goldman Sachs and Nomura swaps? Well, if one of those banks fails to fulfill its end of the deal, or if the over-the-counter swaps become illiquid and hard to sell, the fund really suffers. Then there is concentration risk, purely because the fund's fortunes are entirely tethered to one single company, Apple. And finally, active management risk. This matters because the human decisions made by the portfolio managers might just simply be incorrect, leaving you holding the bag. Because the fund is leveraged at 1.2 times, the math on the downside is extremely unforgiving. If Apple stock were to experience some catastrophic event and drop by 83.33% in a single calendar week, that 20% amplification means the ETF loses 100% of its value. It would literally be completely wiped out. In fact, the Roundhill prospectus puts it incredibly starkly. They state that an investment in the fund could lose money, including the full principal value of the investment within a single week. So you've now seen exactly how these swap structures and implied volatility synthesize massive weekly yields alongside the very unique, very real risks that come with them. The big question we have to leave you with is this. When the next bout of extreme market turbulence hits, will this high-yield engine keep humming, or will the leverage tear it apart?